You must research stocks thoroughly if you want to make high returns in stocks. That was a lie I kept telling myself when I started investing. And I'm sure that's something many people struggle with. So today, I will pop this bubble for you. I will tell you how I completely sidestepped the research part, yet still generated over 60% compounded returns from stocks using just data, charts, and some rules. Like you, I also felt this was impossible. Now I know it is doable. Anyone with an elementary education can implement this no research investing system. The great returns are just the outcome of a process. So, when I started investing, like everyone else, I thought the best way was to borrow ideas from the news. It backfired quickly. But then I read I must research my stocks thoroughly before investing. So, I started doing that. But the research part was very overwhelming. I will drown myself in reports to understand business, growth prospects, management quality, return metrics, forward numbers, balance sheet, valuations, and whatnot. But it ended up confusing me even more. The more businesses I read, the more things I started to like or dislike. If that were a complex business like pharmaceuticals, it would be such a huge speed bump in my entire process. When I liked a few businesses, I had a different problem, the problem of plenty. With my limited capital, it was impossible for me to pick several businesses and still hope to make big money. I did that regardless, and the results were disappointing. See, all this talk of extensive research sounds good when people are summarizing to other investors. It only makes theoretical sense. The content creators and fund managers themselves don't do it. Don't believe me? Go on, open the website of Marcellus Investment Managers and look at the quality of content they put on their research process. On the other hand, look at the fund. It is a big dud in performance. Or listen to Madhu Kela describing his research process in Divi's labs.
जब मैं डिवीज लैब को मिला, मुझे कुछ पता नहीं केमिस्ट्री के बारे में, फार्मा के बारे में मुझे कुछ नहीं पता. ये कुछ 20-22 साल पहले की कहानी है, राइट. पर मैं उसको ये रिलेट कर पाया कि यार ये साला अपने जैसा पैशनेट आदमी है और इसकी जिंदगी में ये कुछ करेगा पक्का. इसकी समझ पूरी क्लियर है. और
Well, in this case, that stock ended up doing well. But then he sold too soon. Despite the deep research pointing towards continued business momentum, he sold the stock when he felt it was too expensive. Do you notice a lack of consistency here? The truth is, these people have mental frameworks and they use these frameworks to make quick decisions. Some frameworks work much better than the others, and that is why the performance varies vastly between funds and investors. The extensive research is, just a marketing gimmick. The mental models are a good, quick way to invest for great returns. But these mental models also fail. When that happens, these people adapt and make changes to fix them. They never resort to deep research for answers. When I realized this problem, I thought of tackling it methodically. I was reading and watching content as a psychopath to find answers to my investing questions. That is when two things strike me. First was the comment made by Rakesh Jhunjhunwala in an interview, and second was a comment from William O'Neill. In his book, O'Neill says that the best movers are the stocks that are already outperforming the majority of markets and have triple digit EPS growth quarter after quarter. I thought, why am I researching to predict the stocks that will see that kind of growth in the future? Why not look for companies that are growing at that pace now? If I find them, I don't have to guess. Plus, they're going to be quick movers as well because most multi-bagger returns in stocks coincide with the time their earnings are growing at a very fast pace. That is the impact of earnings growth and valuation re-rating. So it is a win-win. You get multi-baggers and you don't have to wait. With this newfound knowledge, I ran this screen. But that led me to another problem. There are hundreds of stocks showing 100% plus EPS growth in recent quarter in any given quarter. I was back to square one. Remember, I was so overwhelmed by the number of stocks I would like to invest in after research, I had the same problem again. But then I decided to go on an elimination spree. If the company's EPS was growing at 100% plus pace for 2-3 quarters, that's a known story, then pass. If the current quarter EBITDA is not the highest ever in the history of the company, no inflection point in the business, pass. If the relative strength RS, not RSI, of the stocks is less than 80, the market isn't convinced about the earnings. Pass. If the stock did not react well on the earnings day, pass. I kept eliminating the stocks using several other parameters, and the list that ran into 300-400 stocks was cut to 15-20 names. Wow, that's great. Nope, that's still a lot. I need to build a 5 stock portfolio. Why? Let me tell you. Andrew Carnegie once said, "The concerns which fail are those which have scattered their activities. The great successes of life are made by concentration. Put all your eggs in one basket and then watch that basket." I wanted the same for my portfolio, to manage a concentrated basket of high risk growers. In that, I will let the winners run and cut the losers short before they deliver a big dent. So I went on another elimination spree. I removed the commodity businesses and focused on scalable consumer and industrial businesses. Most importantly, I looked for patterns. If 2 or more companies in the same sector show up on my screen, I would prefer them over standalone companies with no sector tailwind. For example, in 2020, this helped me get on chemicals, pharma, and steel companies. In 2021, I got textiles and autos. In 2023, it was transformers, railway, and defense. And recently, it was pharma. After doing this elimination, the list will shrink further to 8 to 10 names. Those 8 to 10 names went into my watch list, but I was about to run into another problem with them. I thought it is best to buy these stocks when they come down 15 to 20% or more from their top. I did that and it worked beautifully. But things changed when there was a market wide correction. Most of these stocks will go down 30-40% or even more, making a big dent in my portfolio. Half of whatever I made in bull markets will evaporate in corrections. It was frustrating, but I had come too far to let it go. So I recalibrated. I decided I will now buy only when these stocks show signs of recovery. I will add some in recovery, then I will load up on the breakout. I also decided not to act on stocks if the market indices were in a downtrend. Lastly, I entered everything with a logical stop loss. I will give the stock enough room to move around, but if it falls below my logical stop loss level, I will sell. So the playbook was clear now. Mark the stocks with 100% plus EPS growth in a quarter. Look for companies with their best quarters in many previous quarters. Check for technical strength. Check for market strength. Check the result day's reaction. Eliminate based on sectoral patterns and industry. Prepare the watch list. Look for recoveries and breakouts in the watch list. Finally, enter with a logical stop loss. But, I still had problems following the system. And that is the deeper problem many people face in investing. See, going from extensive research to blindly following rules-based system is not going to be easy, and it was not easy for me. I will often doubt the system. I will not take trades or buy too little of a stock only to see it shoot up massively. That was very frustrating. I will then disregard rules and take random trades hoping to catch up, or I will sell stocks that were sideways in the portfolio only to see them becoming multibaggers later. It was an emotional problem. Perhaps that is the problem that destroys more stock market careers than anything else. But let me tell you something. All it requires to make it big in investing is the discipline to take action when things are hazy. Because uncertainty is what you're betting on. If I'm not betting big because I'm scared or my friend doesn't like the stock my system is flashing, I'm preparing myself for doom. In those moments, I thought I had rules to save me in case things didn't go as I would want them to go. So I went back, this time with just one aim: follow the system and leave the results for later. Trust the process. And I'm not gonna lie, it was quite volatile. Yet, it worked beautifully. I got on a few multibaggers that surprised even me. To name a few, Shilchar Tech was up 50 times, Newland Labs was up 10 times, Anantraj was up 10 times, Shakti Pumps was up 6 times, Acuitas is up 3.5, 4 times, Cartrade was up 3 times, and another stock last year, Indochem, was up 4 times, and now Venus Remedies is also up 4 times. You don't need many multibaggers for a 50% portfolio CAGR. But you must load on to the ones you get. If the stock where you have 20% of your portfolio becomes 10x in 2 years, your portfolio doubles even if other stocks go to zero. If one goes 10x and other goes 5x, your portfolio triples. That is how most successful investors grow. They get a handful of super multibaggers and let them do their job. All you need as a small investor is an easier mechanism to find those stocks and trust the system when you get them. The system worked 20 years ago, it worked 5 years ago, it still works and will continue to work in the future. You just need to stay on. Now, you tell me, what do you think about this process of mine? Let me know in the comments below and subscribe to the channel for more such content. Thank you for watching.